So again, welcome everybody. This is the Smart Passive Investor Mindset webinar. It's an educational webinar series that I started putting together. Maybe this is our 6th episode. So we have had 5 phenomenal episodes, tons of attendance and tons of attendance today as well. Our goal is to get you guys educated, learn as much as you possible before making any kind of investments. The whole idea is for you to get smarter before you do any kind of risk taking, understand the risks or any investments. Today's topic is tax smart strategies, one of the best topics that I could bring to you. There's so much known about taxes. There is so much not known about taxes. And Ted is here to explain all of it to us. Just before we get started, some quick housekeeping rules that we have. Everybody's going to be on mute except Ted and I. That's just to maintain the quorum here. If you have any issues, just type it in the chat box and let me know. I'll take care of it. If you have questions, please hold them in the Q&A box and we'll get to you all the questions after Ted's presentation. Definitely we'll have enough time for answering all your questions, so don't feel shy. Start typing the question and whenever you're ready, but we'll take some time at the end to answer them all. Keep your questions in the Q&A box. Don't type in the chat box because I will be monitoring the Q&A box. This webinar is going to be recorded, so don't, feel free to take notes. But like I said, the recording will be sent to you. So stay focused, stay Zoom locked in, ask questions. Just to avoid it from going to any spam folder, just whitelist my email address. That's raj@smartcapitalmanagement.com. Make sure that get you the recording. Quick disclaimer here. This webinar is for educational purposes only and should not be considered as any legal, accounting, or investment advice. Any information in the document does not represent any offer to sell or solicit any purchase of investment security. Please, please, please always consult your own attorney, financial advisor, or your CPA for legal matter, investments, and tax-specific situations. A little bit about me for people who have not been on this webinar before. And if you have been on this webinar before, sorry for the repeat. I am Raj TEKCHANDANI, founder and managing director here at Smart Capital. I am a techie that turned full-time professional, real estate professional. I had always a passion for leveraging data. I used to do that before my real estate career, and I still continue to do that. I bought my first condo in 2012, and then I bought several more in the following years. Bought my first multifamily, that was a 15-unit here in the Massachusetts area in 2016. It was a lot of work, I realized, so I started my passive investments, invested in a 151-unit apartment complex in Dalton, Georgia. Invested in over 650 units now as a general partner. I've been invited to on multiple podcasts as guest. I do manage a couple of Facebook groups if you're interested, data-driven real estate investing and apartment investing and multifamily syndication. I'm also a member of the Forbes Real Estate Council, where I write on the blog post and on their technology section of real estate. And recently I also published a free email course called 8 Pieces of Pie, which is for passive investor education, and some e-guides earlier to help everybody along in the journey of starting on passive investor education. All of that you can find here at my website. That's smartcapitalmanagement.com. Okay, let me slip that. Smartcapitalmgmt.com. That's my website, and you can find all those pieces there. Now, a brief intro or get Ted. Ted, I had met, maybe last year when I was at a conference, and Ted got up there and just talked about, he delivered so much value on the topic of tax. I was very impressed. And I've heard Ted a couple of other times in other conferences. He's just an amazing wealth of knowledge. Ted runs Lanzaro CPA, a boutique CPA firm. He's not even just a CPA, he's a real estate investor, real estate broker, author, and a speaker. He's got 29 years of real estate tax consulting experience, and he's helped thousands of people like you and me, save tons of money in taxes. With that said, I'm going to pass it on to Ted. Ted, take it on, and I'm going to stop sharing my screen so you can start sharing your screen, if that's okay with you.
Okay.
Okay, Ted, take it over.
Okay, so can we see, can you guys see that?
I can see it, Ted. You're not in the presentation mode, so we can see your slides. So
Gotcha. Hold on. There we go. Okay.
right.
Now we're in a slideshow?
We are in slideshow mode now. Take it over, Ted.
Awesome. Okay. All right. Raj, thank you so much. Thank you for the nice introduction. It's a pleasure to be here tonight. We're going to talk about tax strategies for passive and active investors. We're going to talk about why taking a proactive approach to your taxes is better and how it's going to save you money every year. We're going to talk about great record keeping and how to maximize your tax deductions, and not only maximize them, but safeguard them, because that's important also. Okay. We're going to talk about the types of investors: passive investors, active investors, and real estate professionals. We're going to talk about some tax strategies for passive investors, for the W-2 employee or business owner who invests in a syndication, and I'm going to show you an example of that. We're going to talk a little bit about buying real estate in self-directed retirement accounts, because that's a nice strategy for passive investors. And then we're going to do a little Q&A. So the first thing that I want to stress to everybody on the call is that every one of you is different, okay? And that the tax strategies we're going to talk about tonight need to be specifically tailored to your unique situation. And the reason that is because the strategies that a real estate professional can use are completely different than the strategies a passive investor can use. So how is everyone different? Well, some people are W-2 employees, some people own a business, some people are in the real estate business. If you're a landlord, that can be advantageous. Married versus single. We're going to talk about how you can qualify. You can qualify your spouse as a real estate professional if you can't qualify. Income levels are important, and some tax strategies are income level dependent. What are your goals and limitations, right? You know, sometimes financing is a bigger goal than tax minimization. So we work with people to kind of balance that out. How many properties do you have? Do you manage them or are they managed, right? So the more properties you have, the more opportunity there is to do, you know, some different things with those properties. What type of investor are you? Are you a passive investor, an active investor, or a real estate professional? We're going to talk about, and I'll define all of those things for you. So let's start with, what does it mean to take a proactive approach, right? Well, a lot of people just go through their year, and around March they start organizing their tax information. They probably haven't talked to their accountant all year, and then they go into the accountant's office and they say, here's my stuff, right? And the accountant takes that stuff and he puts whatever numbers are on the paperwork that you gave him on the form, and it, you know, calculates, and you're either, you know, owe money or you're due a refund or whatever your situation, right? Well, there's actually another way to do that. And the other way to do that is sort of the approach that I use in my practice, which is communicating with my clients literally, you know, on a quarterly basis. And I always tell people, look, I want to hear from you, my investor clients, when you buy a property, before you buy a property, before you sell a property, before you renovate a property, before you invest in a syndication, right? You know, during the year while you're running your business, we're going to take various looks at, you know, where you are at every different point in the year. And the reason we do that is because we want to know what's going on, because all good tax strategies, or most of the better tax strategies that can really save you money, are basically implemented during the year, not after the end of the year. They need to be done before the end of the year. So proactive approach means having a plan or a method to capture all of your deductions. Okay, so that, you know, we're going to talk a little bit about record keeping, but that's, you know, that's kind of, you know, the starting point is, how are you planning to capture all your deductions? Are you Are you using the proper tools, not only to do your bookkeeping and accounting, but to be tracking your time as a real estate professional potentially, or time as an active investor, or material participation time? All of those things are important. Like I said, I'm communicating with my clients. I'm asking questions. They're calling me and asking questions. You know, should I buy an auto or should I lease an auto? I'm renovating a property. What's the best way to do that? I'm building an apartment building. You know, what's the best way to do that? How do I get the most, tax deductions when I go to build something, or when as soon as I buy a building? You know, what are the things I want to do? Okay. And then the other thing is timing, right? Timing is critical because in a lot of cases we want to take advantage of certain strategies in a year where income is either higher than normal or lower than normal. I'll give you an example. I have a client who had a lot of capital gains in 2019, okay? A lot of income, over $1 million worth of income that he wanted to try to get rid of. And so he bought a couple buildings in 2019. He's a real estate professional, so he can take advantage of bonus depreciation. So he bought a couple of apartment buildings. They did cost segregation studies. We'll talk about that later. It's basically a depreciation study that allows you to accelerate depreciation on a building and take a large chunk of building depreciation in the first year. And so he was able to basically get like over $1 million of tax deductions to offset the capital gains that he had in that year. So when we talk about timing, you know, that's what I'm talking about. Another example of timing would be a year where you have literally no income might be a great year to convert your retirement plan from traditional to Roth, so that you can take better advantage of, you know, the investing that you can do within your retirement plan. We're going to talk a little bit more about that. So keeping good records. I always say that record keeping is the foundation of good tax strategy. And foundation meaning almost like the foundation of a house. You wouldn't build a house on quicksand. You don't want to build your tax strategy on lousy records, right? Because in a lot of cases, tax strategies are dependent on the investor being able to essentially give me good information at various points of the year, right? So I'm talking to my clients at the end of March, at the end of June, the end of September. Where are you, right? Show me your P&Ls for your business. Show me your P&L for your rental properties. Let's see where you are, right? Why? Well, part of it is having to make the proper tax payments. The other part is when we need to make a decision about what's the best way to renovate. Are we going to classify things as repairs or improvements, right? And how are we going to do that repair or improvement to maximize the classification and the ability to deduct? So all of these kind of strategies that we use are going to be dependent on how much income you have. Because if you don't have any income, maybe it's not necessary to get fancy, but if you have a lot of income, then it's going to be advantageous to get, to get a little fancy and implement something. Also having a good filing system. So I want you to have, everybody should have an account that's basically exclusive to their business, and that they're going to be able to go and, even if they do no bookkeeping throughout the year, they can print out their bank statements because everything ran through their business checking account and for a specific business, for example. And now everything's there. It's all on your bank statements. Even if you did no tracking all during the year, all we need to do is print out those 12 bank statements, hand them to a bookkeeper. The bookkeeper writes them up, and all of a sudden we have that information. Now, I think you should be doing that on a monthly basis, but that's the worst case scenario if you have everything in one account. Too many investors, do have more of a willy-nilly system where they just sort of, put money, take money from whatever account has money these days, whatever day they need it, and put money in their personal account when it's their rents or something. all of your rents, all of your business expenses, your deductions should all flow into and out of one kind of central business account. Having a good filing system, keeping track of, your closing statements, your insurance bills, your mortgage statements, all of these things that you're going to get, syndication agreements, checks you wrote for investments, all of that stuff. You should be able to have a system that allows you to sort of pluck those things, when you need them and get them over. Like, hey, scan them over to me. I need those things to look at so I can determine what strategy to use for you. And then the third thing about record keeping, which a lot of people don't think about, is tracking time. And we were talking about tracking time for being a real estate professional, tracking time for being considered an active investor or material participation in an investment. So, I mean, I use a simple spreadsheet to track my time. Some people use apps. There's some good ones out there. And some people just use a simple spreadsheet, or literally a day timer, the old school, day timer, or your Outlook calendar. You just put in, what time you spend doing what, and with who. And the more detail you can put into those time logs, the better. So if you're trying to establish that you're a real estate professional, and let's say part of that time has to do with your landlording activities, you want to say, went, an hour today, met and went and met with tenant Joe Smith at 123 Main Street to collect the rent, right? Or whatever. But the more detailed you can be with that, the better off you're going to be. Tracking miles, same thing. There's a lot of apps out there from that now. You just press the button when you leave, press the button when you get there, prints a nice report for you at the end of the year. But again, you should be documenting, okay, where did I go? Why did I go there? What property was it for? All of those things are essential kind of good record keeping. And those are the things that when we talk about tax deductions, not only are they going to enable you to maximize your tax deductions, but they're going to safeguard your tax deductions. And that's important. And how many people know the proverbial contractor whose basically filing system is like the dashboard of their truck, right? And every day they just put their invoices up there, or they spend a little money and they just throw it up there. And one day it's a nice day out and they roll down the window and they're enjoying the breeze, and there, whoa, boom, right out the window goes a couple of their tax deductions, right? Well, we don't want that to happen to you. We want you to have a system for basically capturing all of your deductions, because it's amazing how many people leave dollars on the table simply by not having a good record keeping system. So there's 3 types of investors, according to the IRS, and the investors are the type is basically a classification that determines how much of your rental losses you are allowed to deduct against your ordinary income. Now, when I say rental losses, I don't mean go out and buy a property that's losing money, right? None of us, everybody's smart enough not to do that, right? Now, what I do mean is doing the whole reason you want to invest in real estate is I want cash flow on my properties, but I want to use the depreciation on the property, the depreciation expense, to offset that cash flow so that I have 0 taxable income or even a taxable loss, right? So depreciation is basically the rational allocation of the purchase price of the property, which you can take as a deduction every year. I'll give you an example. So the IRS says that a residential apartment building or a residential 3-story house or whatever can be depreciated over 27.5 years, okay? So let's say you go out and you buy an apartment building for $2.7 million. And this is a very simple example. I'm just doing it for easy math. But let's say you go out and you buy a building and the building cost basis is $2.75 million. And I can deduct that over 27.5 years. So I'm going to take $100,000 a year in depreciation expense. Well, that means I can have $100,000 of operating income minus my $100,000 worth of depreciation equals zero taxable income. But I've got $100,000 in my bank account, right? Because that's what I earned. You know, maybe I only earned $75,000 in cash flow, and now I'm going to offset that with $100,000 worth of depreciation, and I'm going to have a $25,000 loss. Am I going to be able to deduct that loss? Well, my investor classification determines whether I can deduct that loss against my ordinary income. So let's start with passive. Passive investors cannot deduct real estate losses from their rental properties against their ordinary income. They don't lose the loss, and we're going to go over an example in just a moment. They don't lose the loss. The loss carries over to be used for future years. I'm going to show you how that gets done. But just know that as a passive investor, your big benefit is I'm going to get cash flow from my investment, whether it's my own properties or a syndication that I'm invested in. I'm going to get cash flow from it, and I'm not going to pay taxes on that cash flow. At least for the first, like in the syndication, you're not going to pay tax on the cash flow, typically for the first 5 to 7 years of the investment. Now, the second category is active investors. And so some of you guys who have your own properties and are managing your own properties might be considered active investors. In order to be an active investor, I've got to be spending at least 500 hours a year managing my properties. And that means, you know, could be doing the bookkeeping, could be finding properties, could be arranging for the maintenance, a whole list of things that, you know, qualify for as active time, right? Now, if I'm an active investor and my adjusted gross income is less than $150,000 a year, then I'm allowed to deduct up to $25,000 a year of rental losses against my ordinary income, my income from my W-2 or my income from my income from my business, for example, okay? Now, when you get over $150,000 of income, the IRS says you're phased out of being able to take those losses, and essentially you become a passive investor at that point, even if you're actively managing. So over $150,000 of gross income a year, you're essentially a passive investor, even if you're actively managing your properties. The third category is called real estate professional. And a real estate professional is allowed to take unlimited losses against their ordinary income. So I've got a client who made about $600,000 this year as a real estate broker, has a bunch of investments, bought an apartment building this year, was able to do a cost segregation study on it, took bonus depreciation of about $200,000, was able to deduct that against his brokerage income of $600,000 and only paid tax on $400,000. So that $200,000 of depreciation expense that he was able to deduct against his ordinary income saved him about $60,000 in federal and state income taxes. In order to qualify as a real estate professional, you've got to have at least 750 hours in your real estate trade or business, and it's got to be more than 50% of all of your business activities. So if you have a W-2 job that you work 2,000 hours out of a year, you need to have 2,001 documented real estate hours in order to be considered a professional. But you can qualify your spouse as a professional, assuming that you file jointly. So let's say you're a high income earner, W-2, and your spouse is a stay-at-home spouse or has a part-time job. Or maybe they're a real estate agent or broker or involved in managing the properties you own or whatever. They can qualify with the 750 hours, and if, as long as it's more than half of everything they do, and then you're allowed to take those losses during, because you're filing jointly, right? So that's a good advantage. So let's take a look at, and we'll talk about that a little more in a minute. Let's take a look at an example of a typical passive investor example. Now this happens to be a syndication, right? So I'm investing in a syndication. I'm putting $100,000 into a syndication as a passive investor. The operator has told me they're estimating a 5-year hold, and then I'm going to get an 8% return on my money. So I put my money in, and in year 1, I get my $8,000, right? My distribution, my 8% of my 100,000. Now, but when I get my form K1, I've actually got a loss on my K1, right? Why? Well, that's because of the depreciation expense, right? So not only did I get passed through some of the cash flow, I also got passed through some of the depreciation. And look, I've got an $8,000 loss, right? Now, I can't take that $8,000 loss because I'm a passive investor. What happens to it? It carries over. Now, let's just say, so I wanted to show you that K1, but in my example, my number is actually 50,000. Why? Because in year 1, the operator did a cost segregation study, and I got passed through, instead of the $8,000 in the example I showed you, I got passed through a $50,000 loss. I still have my $8,000, I have a $50,000 loss. What happens to it? It carries over, right? So now I'm going to take this $50,000 and I'm going to carry it over to year 2, where the next year I'm still going to get my $8,000, and I'm still going to get allocated some depreciation. So this year I'm only going to have a $10,000 loss, and I still can't deduct it because I'm a passive investor. And so now I have a $60,000 carryover. Now let's get to the end. So this happens in year 3, year 4. Again, I've picked up $32,000 in cash. I haven't paid a dime in taxes on it. Okay. I get to year 5, and in year 5, the operator sells the building, and he sells it for 20% more than they paid for it. So now my original $100,000 investment, I'm going to get back $120,000. Okay. So now, because of the sale, I'm able to use my passive loss carryover. So now I'm going to pick up $120,000 of capital gain income at long-term rates, 15% typically, maybe a little higher if you're really high income. But I'm also going to be able to deduct the passive losses that I've been accumulating over the 5-year period. So really my net capital gain is only going to be about $30,000. And my net tax effect on $30,000 at approximately, let's call it 20%, is about $6,000. So what had happened? I actually I invested $100,000 in my example. I got total cash flow of $52,000, right? Because I got $152,000 back over the 5-year period. I'm paying tax on $30,000 instead of $52,000, and I'm paying it at long-term capital gains rate. So over 5 years, I made $52,000, and I paid $6,000 in taxes, about 12%, right? So, it's really a great scenario as a passive investor. So you saw the K1 example. So now, as a passive investor, I can take advantage of some other tax strategies also, right? Because now look, I've got this cash flow. Remember, I got my $8,000 a year, and that's only from one syndication, right? So I've got my $8,000. Well, what can I do? I know I'm not going to pay taxes on it, right? So now, what am I going to do? Maybe I haven't max funded my 401k for my W-2 job, So maybe I'm going to use that cash flow to help me fund my retirement plan at work. So now I can't deduct the tax loss against my ordinary income, but I can reduce my ordinary income by using my cash flow to fund my retirement plan. I can defer money at work and use the money I get from my investment to supplement, my at-home dollars that I need to pay my bills. The exact same strategy works for business owners just on a much larger level. Because if you're a W-2 employee working, you can fund your 401k up to about $19,000 in 2019. If you're over 50, you could take it up to about 25. As a business owner, I can fund up to like $59,000 a year. I think that's the number for 2019. And so the cash flow, let's say I use all my business income to pay my bills, but I've got cash flow coming in from my syndicated investments, and I use that cash flow to fund, now I didn't pay taxes on that cash flow, and I'm using it to fund my retirement plan, which gives me a tax deduction against my business income. So now I've reduced my business income by the amount of cash flow I put into my retirement plan. So that's a great strategy to kind of get around the fact that as a passive investor, I can't deduct my rental loss. And and this is confusing, so I will definitely take some questions on this, I'm sure. The other thing that I can do with my passive losses, okay, is that I can offset my active real estate investment income. So let's say I have a portfolio of properties, maybe they're a little more mature, I've already taken a lot of the depreciation, mortgages getting paid down, they're generating a lot more cash flow than I can offset with the depreciation on those. Well, now I can go and get into a syndication and use the depreciation from the syndication to offset my active rental income or any other rental income that I have from other sources. So that's another great strategy. Even if you're a passive investor, if you have other rental income, you can offset the losses from, say, syndications against that active rental income. The other thing that we do, and this is something that I teach, and I don't know that a lot of people talk about, but, and this comes down to record keeping, right? It's building up your passive loss carryover, right? And when I'm talking about when I'm saying building up is keeping track of all of the expenses that you incurred when you were looking for, evaluating, networking to find the investment properties that you're investing in, right? So even if I can't deduct the rental losses in the year that I've taken, the year that I get the loss, even if I can't deduct them, I still want to max them out. So let's say, just as an example, in the other example where we had $10,000 a year of passive losses, let's say I also kept track of all of my travel, meals, and other expenses relative to finding those investments, networking, going to conferences, all of that. Well, I can deduct those expenses in addition to the losses. Now, I'm not able to offset my ordinary income with it, but let's say I added $3,000 a year for 5 years. That's an extra $15,000 I can deduct when the syndicator sells the property, and I'm able to take even more passive loss carryover. The last thing we're going to talk about is using your IRA to invest in syndications as a passive investor. So let's just start with some basics, which is the difference between a traditional and a Roth IRA. Traditional, I deduct the money, I get a deduction when I put the money in, it grows tax-free, but I pay taxes on it on the way out, okay? A Roth IRA, I use after-tax money to fund it. I still get tax-free growth through the entire life of the IRA, and I don't have to pay taxes on the way out because I didn't deduct it on the way in. So you can use these self-directed to invest in either your own real estate or syndications. So why is this a great idea? Well, because there's no tax consequences as long as you put the cash flow back into the retirement plan. There's no tax consequences until you take the money out. Why can this be a terrible idea? Well, there's a lot of rules. And if you're one of these people who are like, rules, well, this is probably not for you, or if you're a horrible record keeper, this is not for you, right? You need to be able to follow the program. You need to be able to keep good records because you want to make sure all of that money goes back into your IRA. So just understand that you can use your retirement accounts to invest in real estate. So let me just tell you a little bit about when I talk about being proactive and record keeping and all that. The net result of that is customized, tailored tax planning. This is what I do all day, basically, is I look at people's situations and I devise what strategies are going to help you save the maximum amount of dollars. So it starts with analyzing and understanding your situation and what your goals are, and then developing a strategic plan to minimize current and future liabilities. That's what when we're talking about the passive loss, maximizing your passive loss carryovers, we're talking about minimizing future liabilities. It's proactive. It's something that most CPAs are not doing for their clients, not advising them to do that because it doesn't affect the bottom line today, right? But it does affect the bottom line and could save you $3,000 to $5,000, $10,000, whatever, 5 years from now. So that's what being proactive is. Very often I'll be preparing a tax projection which incorporates the plan. So I show people, here's what you do, here's what happens, here's what you're going to owe if you do nothing, here's what you're going to owe if you implement our plan, and here's how much money you're going to save. And then I help them implement and document the plan. And then the last thing is to make sure all taxes are paid to avoid penalties, because we certainly don't want to pay penalties if our goal is to minimize taxes, right? So now we can take some questions. 2 rules for questions. There's no such thing as a stupid question. So just ask away. I won't laugh at you, I promise. And if I don't know the answer, I'll tell you, because I'm not, I know a lot about this, but sometimes I'll get stumped. So let's start with that.
All right. So can you hear me now?
Yeah, I got you.
All right. I just had the mic off. Just soaking in all that stuff. So I just, kept my video and mic off. So here we go. So we have a bunch of questions, Ted, and which is my favorite part of these webinars, that, people get to ask questions and experts like you answer them, live. I think the first question came from Austin. Austin says, does all this apply to Canadians?
Well, if you're Canadian, now Canada has a completely different tax system when it comes to bonus depreciation and depreciation in general. But if you're a Canadian investing in the United States, then yes, this does apply to you for your US tax return.
All right, I think the next question was, do seminars and webinars or live networking events counts towards your time for the QREP, which is, I think, the real estate professional status?
So does going to conferences count? Is that the question?
Yeah, that's the question, I think.
Okay, so my answer to that would be, generally speaking, no. But more specifically, yes. And here's what I mean by that. If I'm at a conference and I'm sitting and I'm listening to, any number of gurus, educating me about real estate, then I don't count that, okay? But I'm going to count and I'm going to track when I walk out in the hallway and I talk to Raj about, hey Raj, what deal are you working on these days? What do you got for me to invest in, right? Or and meeting people, and I'm going to write in my log, spent 20 minutes talking to Raj about, bippity boop, development or whatever it is, right? And so I'm going to count all of that time. And at conferences, I'm willing to bet probably 30 or 40% of the time you spend at conferences is networking and meeting with people. And so I'm going to track all of that, because that is good time, because that's how you find deals.
Next, Gaurav wants to know, Ted, can you please elaborate, if you get a K1 from an LLC from syndicator deal, which is greater than 25,000, then can you get the paper loss to offset W-2 income greater than 200,000 a year without the professional status, real estate professional status? I think the answer is no, but
the simple answer to that is no. Yeah, unfortunately, that's the answer. But here's the more detailed, tailored answer, right? So no, but did you use the cash flow to max out your 401k? Are you maxing out your 401k at work? Did you do a spousal contribution for your spouse? If like an IRA, spousal IRA contribution for your spouse, with that dollars, if you have a spouse? Did you max out your HS health savings account if you have one? Because those are all deductible uses of the cash flow from the syndication.
And then he further says, can you please elaborate on NOL, that's the net operating loss, carry back with the CARES Act / TCJA, of course. If I cannot shelter my entire 2020 income this year, can I cover it in 21, 22 by having enough losses in 2021 and 2022 to cover the 2020 income?
Yeah. Well, let's start with the whole concept of the CARES Act, right? Which is, if I'm a real estate professional and I have the ability to take more losses from bonus depreciation, say in 2019 or 2020, let's call it 2019. So if I have more losses than I have income, let's say I generate, so I had this very situation where a guy who makes $500,000 actually had $1 million worth of bonus depreciation. So now he has negative $500,000 worth of income this year, right? But what does he do with it? What the CARES Act, you used to have to, the rule was before the CARES Act, it had to be carried forward, right? Now that the CARES Act has been put in place, it can be carried back. It can be carried back 5 years, right? So now you can carry that back 18, 17, 16, 15, 14. You can carry that back to 2014, right? A 2019 loss. Now, but you have to start with 14. So you would use that. In this guy's case, we looked at using the $500,000 to offset his 2014 income, then his 2015 income, then his 2016 income, right? Well, what we found was he didn't make that much money in 2014, 15, and 16. So the tax rate that he was actually paying taxes on was low, right? And so then we said, well, wait a second, what's your 2020 and 2021 income going to look like? And it turns out he was going to make a ton of money in those years, right? High tax bracket, right? So in his case, we did the analysis, and this is an analysis, right? We did the analysis and we determined that it was better for him to carry forward than carry back, even though with the carry back, he could have gotten immediate cash in hand, but it would have been a lot less money than if he had carried it forward. So to answer your question, if you have more income in 2020, 2021, then it's more beneficial to carry it forward instead of using the carryback to offset it at a lower rate.
Thank you, Ted. Next question is from Dwayne. Dwayne asking, if you use a solo 401k / STIRA, the loss of 𝐭𝐚 does not have any benefit. Is that right?
That is true, right, yes. Yeah, well, that's strictly, using the IRA is strictly a cash flow deal. How much money did I put in? How much money did I get out? That's all you're worried about.
Eric is asking, lenders like to see how well properties are performing when underwriting you for a new loan. That means having as much income as possible on tax return. How do you rectify that versus claiming expenses that reduce income on returns?
Yeah, and that's a tough one. Remember I talked about goals, you know, at the beginning of the thing, and I said that very thing, which is, you know, sometimes we have to, sometimes tax minimization can't be the ultimate goal. Sometimes ability to finance, you know, takes center stage because, you know, you might be doing your taxes and you're like, hey, Ted, I need this return to close on my next deal, and it needs to show blank amount of income or I'm not getting a loan. Okay, well, you know that though in advance. Now, typically what I would tell you is most lenders will add back depreciation, right? So we're typically going to be more aggressive with the depreciation in a situation like that and less aggressive with, you know, the other kinds of expenses that are going to be considered part of the net operating income. So we want to maximize net operating income and then let the depreciation do its magic. And typically the lenders are going to add back the depreciation in determining the cash flow of the property, but you're absolutely right. It's not, tax minimization and ability to finance are, on opposite ends of the spectrum.
Raj Singh wants to know, so he says, this year, most of the investors are not buying as they were buying pre-COVID. And this may end up having a lot of taxes due next year. Is there any changes we will see for this year, changes in taxes? I feel most if investors who slow down will pay a lot of taxes next year. One angle, if they buy, I see real estate prices will drop 10 to 30% in the coming 2 years. Any thoughts on this?
Yeah, well, I get what Raj is saying, and the fact that if you didn't buy anything this year, then you're not going to have that bonus depreciation. In a lot of cases, if you're a real estate professional, you're not going to have that bonus depreciation to offset your income. You have to just look at, if that's the case, you have to look at what other strategies are available. Okay, and that's where the planning comes in, right? So look, I mean, nobody has a crystal ball to determine, when the market is going to tank, if the market's going to tank, what's going to happen. Is it harder to buy properties right now? I guess. I don't know. I still see people doing deals, but I see them doing less deals, right? So, but I've got a number of clients right now who are actively purchasing properties. So deals are happening. Now, with that being said, yeah, it's just, if you can't find a deal and you can't use that bonus depreciation to offset this income, then that's when it's time to look at every other strategy that's available.
Okay, thanks. This person says, name keeps it anonymous, but he's asking, or he or she is asking, can you suggest any method to minimize the long-term capital gains tax on the recent sale of a business?
Well, again, it's specific to the way that the sale was structured, right? But let's say there's real capital gains there. Investing in an opportunity zone may be one of the because you can take those capital gains, doesn't have to be from real estate, and they can be invested into an opportunity zone fund, right? I can also offset capital gains with rental losses if I qualify. So a lot of it has to do with your specific, or I can make a large retirement plan contribution. It all depends on your specific situation. So that's a tough question to give you a really good answer on without actually looking at what you did, how much, and that sort of thing.
This goes to, every situation is different and every investor is different.
Yeah, and that's a tough one because business sales have different components, whether you sold equipment or goodwill or whatever. So.
Let's move on. Sharad wants to know how timekeeping will help in tax strategies. I think it's probably timekeeping as in real estate professional case, right?
Yeah, not only that, but you're supposed to be keeping time to track your active investing hours too. So if you think you can qualify as a real estate professional, then tracking time is going to be something you definitely want to do. If you're going to be deducting the $25,000 as an active investor against your ordinary income, you definitely want to be tracking the time. Why? You might get called into the IRS's office, right? And if you don't have a time log, then you lose, and you're going to write a check, right? And if you do have a time log, you're probably going to be out of there in 10 minutes because that's what they called you in there for, right? So it's a safeguarding device, but I'll tell you this, I very rarely, especially if somebody's already got a W-2 job, I very rarely will allow somebody to say they qualify as a real estate professional if I know they don't have a time log, because that just says to me that they're probably making it up, frankly.
I think ties into the next question which Jed's asking. Jed says, when claiming to be a real estate professional, what are the odds of getting audited? Is the IRS more likely to audit?
Well, they're more likely to audit if you have a W-2 job, for sure. That's probably one of the bigger red flags. With that being said, You know, under ordinary circumstances, you've got just as good a chance of getting hit by lightning as you have of getting audited, right? Now, when you take the real estate professional status, that risk does go up for sure, right? But is it? I mean, if they audit half of 1% of real estate professionals every year, that would be a lot.
Matthew wants to know what tool do you use? What tool do you use to keep track of losses on your properties so you can recall them when you sell?
Well, I mean, look, I use the tax returns, right? Because you know, my tax returns are going to tell me what my losses are every year, and they're going to accumulate on the tax return. So you should be able to look on. God, you're going to hate me because I can't remember the form number, but I think it's 8582. It's the passive loss form, and you should be able to see on that form what your accumulated losses on each property.
Zubin wants to know, do you do taxes for clients in all states, Ted?
Yeah, I work nationally, so on a given day, I could be doing state returns in 8-10 different states.
Okay, great. Matthew wants to know, can you talk about UBIT? I fell into this when I used my self-directed Roth IRA to invest passively. Should have just used a self-directed traditional IRA.
There are situations where you can, using an IRA, be subject to UBIT tax. Those are typically going to be in situations, though, when you invested in a syndication that is more development or business oriented, because rental income and capital gains are not subject to UBIT tax.
Ankit wants to know, for someone who may be searching for real estate tax advisor, what are the characteristics of a traits of a good one? What kinds of questions should I be asking?
Yeah, no, that's a good question. Look, I mean, there's a short list of really good tax advisors, but the thing that I would ask is, are you an investor? The first thing I would ask is, are you an investor, right? And how many real estate clients do you actually have? Because I've been an investor since 2002. I've been buying and selling, landlording, rehabbing, investing passively, developing, since 2002. So how many years now? Like almost 28 years now, right? Or 18 years now, right? 28, 29 as a CPA. So that would be the first thing. Are you an investor? My practice is exclusive to real estate investor. So, is this your niche, or are you a generalist? I would stay away from people who do a little bit of everything, and I would look for somebody who's a specialist, right? Are you aggressive? Are you, or are you very cautious as a CPA, right? I'm legally aggressive. I believe in taking the maximum amount of deductions, but I believe in documenting it too, right? So, are you going to help me documenting it? I like, the reason people come to me a lot of times, I'll hear, my CPA is really good, guy, gal, they know taxes, but they're not specialized in real estate. So what can you do? And typically when I look at the returns, I find things that I can improve. So those are a couple of, just a couple of hints here. Always look for somebody who's actually invested.
And Ankit is also asking, we are halfway through 2020. If you had a client with significant capital gains this year, and they are new to real estate investing, what would you recommend they do for the remaining 6 months to take advantage of tax benefits in real estate investing?
Yeah, well, there's a variety, there's a small variety of things you can do. We talked a little bit about opportunity zones with the other question about the business capital gains. That may be something, an opportunity zone fund would certainly offset capital gains if you could find somebody who's doing an opportunity zone syndication. That would probably help. But again, contact somebody who is a proactive planner and start now. Don't wait until next February or March to get your strategy. Let's in your if you were using me, I would say let's talk now.
Jed's asking, I find tracking time to be a headache. all my calls looking for properties, etc. Once I hit 750 hours, should I stop tracking? Or do you have a good app that I can use to track all of this?
Yeah. You know what? The answer to the first question is no. You want to, I never want to win by 1 point. I'm one of those guys that wants to run up the score, right? So yeah, I want to, because I never know if the IRS is going to say, oh, that hour doesn't count, right? I personally don't have an app that I use. I basically use a spreadsheet, and I understand that it's a pain in the ass. Hire somebody to do it. Figure out a way to just be able to just notate it, and then maybe have an admin, a virtual assistant or something, take your Outlook calendar or whatever and formalize it for you. Maybe you just write, like maybe you just keep a timesheet, right, with little notes, and then have somebody formalize it for you.
Let's check the time check. It's 8 o'clock. So we'll keep going for a little more because we have a bunch of questions and I promise people that we'll answer as many as possible here. Josh wants to know, can you count time you spend trying to acquire a property, even if the property acquisition falls through at the very end for real estate professionals?
Yeah, and exactly. I'm going to document all of that. And that's why I say, when I go out and look at a property, I'm going to count going out and looking at properties, right? But the other thing that I'm going to do is when I go, and I used to do this all the time. I don't look at as many properties now as I used to, but I would go out and look at, 40 properties over 2 days, right? And I would have a little piece of paper that I printed out, from whatever source I was using that had the address on it. And then I would go to that house and I would take notes, right? Or I would go to that property and I would take notes. And I kept a binder of those. And the addresses were in my log, right? So I saw that house because I've got pictures of it, and I've got my notes on what my thoughts were. I even did maybe an analysis sheet on the ones that I thought might be good buys, right? So I'm keeping all of that information. I'm keeping my pictures, everything, because I'm going out there with some sort of evaluation form, and not a camera, but everybody has one on their phone now.
The next one is from an anonymous. Does depreciation/passive losses work to offset state income taxes?
Depends. There's a lot of states that have taken the position and taken the rule that they're not going to recognize bonus depreciation. So, for example, the state of California adds back bonus depreciation when they calculate California taxable income. So it's state specific.
And Gore was asking, can the passive investor get all the accumulated K1 losses benefit when the property is sold, even if the investor does 1031 exchange on sale of property?
Well, no. So no, you're not going to get the benefits of those losses if you 1031. All of those benefits are going to carry into the new investment.
Okay, another anonymous is the 3.8% net investment income tax added onto the depreciation recapture tax?
That would be income dependent. Might be. Yeah, might be. Depending on how much income you actually have, yeah.
Okay, Samir wants
taxes. It's not really added on, but it could be on the same. It certainly could be generated on the same return.
Okay. Samir wants to know: is it better to have all properties under one LLC or multiple LLCs?
That is. I would. Again, it's really specific to your situation, right? I would not own a whole bunch of properties in one LLC. But what I would say to you is, I know of situations where that's not the worst thing in the world. Let's say I had 10 properties and they're all 95% leveraged, right? Well, I can have them all one LLC. Who cares, right? I wouldn't do that if I owned 10 of them outright. I probably have 10 separate LLCs, right? Because I don't want to lose the entire interest if one bad thing happens in one LLC. But if I've got 95% financing on all 10 of them and they're all in one LLC, who cares? Take them all, right? But that's specific to your situation, and that's something you really should have somebody somebody take a look at who knows what they're doing, somebody like myself, you know, or an attorney who has a lot of experience with that, because there's a whole bunch of factors that goes into that decision, and it has to do with whether you're, you know, a risk taker or risk adverse also.
Great. Also notice I just opened up the chat box here. There's some people typing up the questions in the chat box. I would encourage just copy and paste on the Q&A box, because I'm just
I'm
going.
not answering those.
Let's go on. Christopher Morgan is asking, depending on what happens in the election 2020, do you foresee the Tax Cuts and Jobs Act being repealed and thus affecting backward-looking bonus depreciation?
You know, the Tax Cut and Jobs Act was such a massive piece of legislation, right? They don't overhaul the entire tax code that often. I don't see that happening. Could they tweak it? Sure. And tax laws change all the time. They're still changing things from the Tax Cuts and Jobs Act. So.
All right. This is, I'm interested in finding a REI focused CPA. Should I be focused on CPAs who are in my state? Is individual state knowledge important?
I mean, somebody like myself who, you know, who works, you know, across the board, works in a lot of different states, we get to know the individual states because we do that many tax returns, you know, in them. With that being said, I know California, for example, a lot better than I know South Dakota, right? Because I just do that many more, you know, California returns. It's really your preference. If you prefer to be able to work with somebody locally who you can go to see live, you know, in person, you know, post-COVID, you know, that's really a personal preference. I have a lot of clients, you know, like I work with people all over the country, and we work on Zoom and email and whatever, and we don't have any issues with that.
Anonymous wants to know, does Massachusetts allow for bonus depreciation?
Does Massachusetts allow for bonus depreciation? That's a good one. I don't think so, but I don't have them memorized. So I don't think so. I think Massachusetts adds it back. I think.
All right, we'll confirm that later. Dwight is saying that I have a high-paying W-2. My wife and I are also realtors. Can we qualify as real estate professional based off of her alone? She just got her license this past February. However, I have been a realtor and investing for years.
Yeah, I mean, if you've got a W-2 and she doesn't, then she should be the one trying to qualify. And what you want to do is you want to push as much of that property management work and as much real estate agent work as you can to her, so that she can get the documented 750 plus hours. And then that would allow you filing jointly to claim to be a real estate professional without you having to qualify.
All right. The next one is from Gaurav. This is a long one, so stay with me, Ted. Which one is better tax-wise, to use CARES Act loan up to $100,000 to pull out of a 403B, or use the CARES Act withdrawal up to $100,000 without 10% penalty due to COVID-19 hardships? This CARES Act gives opportunity to withdraw money out of the 401k and use this money for good real estate opportunities, ?
Yeah. So I'm not sure what the distinction is there, but what the CARES Act allows you to do is take that $100,000 out. And as long as you put it back by the end of, so there should be no penalty, and you don't even pay the tax on it if you put it back within 3 years. But let's say you get to the end of year 1 and you haven't put it back. Now you have to pay tax on a third of it, right? And then if you haven't put it back by the end of year 2, you're going to pay tax on another third of it. And then let's say you go back and then you put the money back in year 3, you have to go back and amend years 1 and 2 in order to get the money back. So you pay the tax, you amend to get the money back, but all in all, it's a tax-free transaction, no penalties. So that's not a bad way to go, but you and it's not a bad way to go, even if you're paying the tax in thirds, right? So if I pull $100,000 out and I normally would pay taxes on that 100 in year one with a penalty, right? Then being able to allocate it over 3 years without a penalty, and probably at a lower bracket, is not the worst opportunity on it.
Matthew, sorry, this might have come in earlier and I missed it. He says, Ted, isn't the gain from 2 slides ago in the example just 20,000 and not 120,000? So I don't know if you can go back to the slide that he's referring to. Maybe this one, gain of 20,000 versus 120,000. So he's saying, isn't the gain from the slide example just 20,000 and not 120,000?
Yeah, the capital gain on your investment is 20,000 capital gain, right? But you also have to factor in the fact that your basis has been, so you're getting the cash and your basis has been reduced by the distributions that you receive. So you actually got $52,000 in total dollars on your 100. So you ultimately, he's right, you have a $20,000 capital gain. You put in 100, you have 20,000, but you also have this basis reduction.
I'm just going through back of the questions in the chat box, and I missed probably something from Justin. He says, at some point in the future, I'll be living off of my income from syndication investments. How will the losses work if the only income that I show on my taxes? Will I pay no tax and also be able to roll over K1 losses to next year to use towards the sale?
Yeah, I mean, if all you did was invest in syndication, then probably the only time you would actually pay taxes is if all of the is when syndications actually sell properties. Then you would have some tax ramification in those years. But in a year where all you did was, assuming you're in years 1 through 5 or 1 through 7 of each of the syndications, all of your cash distributions would probably be tax-free, more than likely, yeah.
Great. I think I might have covered all the question. If I missed something in this, chat box versus Q&A, then my apologies. But I think we have taken all the questions. Unless there are any more questions, we'll wrap it up here. Ted, you want to share how people get in touch with you? And
yeah, so I was just about to go there and I screwed up.
And tell them about your book as well, Ted, while you're at it.
Yeah, that's where I was kind of going. Hold on a second. Yeah.
This is the last slide there, yeah.
Can you still see the screen?
Yes, now we see it. It's still not on slide mode, but we see the slide. It's not in a.
So if you go to www.lanzarocpa.com, you can get a digital copy of my book, The Tax Smart Landlord. It has 39 tax strategies for real estate investors. I think it's a good book, and I think you'll learn. I haven't met anybody yet who told me, oh, I didn't learn a thing from that book. Even sophisticated investors, have told me, oh, there was a few things I learned from that I'm not doing. So it's a good opportunity. You can get that. There's bonuses that come with it. So you'll get 5 email bonuses with it when you sign up. And you can, as far as contacting me on the Lanzaro CPA page, there's also a section called Working with Ted Lanzaro, where you can go on and schedule an introductory call on the website. Or you can email me at ted@lanzarocpa.com, or you can call my office at 203-922-1742. That's 203-922-1742.
Great. Once again, Ted, you have added tons of value in this short time. I really, really appreciate you coming on and helping all these people who are so curious about taxes and real estate. So thank you to all the attendees. Thank you for taking the time. I know it's busy out there and it's tough to take times in the evenings, but I hope you enjoyed the talk and hope you learned something from it. And if you have any, if you want to reach out to Ted, the information is right there. And once again, thank you and good night, everybody.
Good night, everybody. Thank you.